Okay, we're gonna do this question where company A is buying company B. This question is actually prepare the consolidated balance sheet on January 1st, year 6 under entity theory. So this is company A is purchasing company B. They're paying $328,000 cash to acquire 80% of the common share of company B. This is the balance sheet of company A, balance sheet of company B, fair market value of company B's assets and liabilities. And company B also had a domain name which was worth about $54,000. Okay, so we're gonna start by recording the cost. Purchase price of B. Purchase price of B is $328,000. And what was the value of company B at 100%? So at 100%, their value was actually buying 80%. So 80%. So the value for them at 100%, it would have been 328,000 divided by 80% of the 410,000. Now we have to see what was the difference between their assets and their liabilities. So their assets was 297,600. Assets were 297 and 600. Their liabilities were 36,000 and 66,000. So that is 36 plus 66. So 36 plus 66. Setting 102. Oops. It's 102,000. So this minus this, assets minus liability, minus assets minus the liabilities is equal to 195. So their price at 100% was 410,000. So assets minus liabilities is that, so which means their retained earning and common share is equal to 410 minus this, oops, it's equal to this minus this. It's 214,400. That is the acquisitional difference. Differential. So now we have to see where this price. Okay, what happens is when you buy a building, sometimes the building value can increase. Their book value can be different, but their actual value can be different. So we have to see why we paid 214,000. So first thing we're gonna find out. What I do is I used to put fair market value here and their book value here. Okay, you will know in a minute. Now when we go back here, the accounts receivable, their book value is 26,400, but the fair market value is 22,000, which has changed. Inventory fair market value is 89, but on the book we have 69,200. So you have to find out that difference. So first of all, we're going to take their accounts receivable. Accounts receivable is this. Is that fair market value for accounts receivable is 22,000, and their book value is 26,400. Next we have is inventory. Their inventory fair market value is 89,000, and their book value is 69,200. Next we have is plant. Plant had a fair market value of 169,000, and their book value was 165,200. For plant we have patents. Patent is, their book value is 26,400, and their fair market value is 62,000. Okay, then we had that, what else we have? We have trademarks. Trademark has a fair market value of 34,000. Their book value is 0 because we don't have anything. And then we have this domain name. And this domain name. Domain name is worth 54,000. Fair market value is 54,000. Book value, because we didn't have anything from before, is 0. And that is all for assets. Then we have current liabilities is 36. Current liabilities is 36. They're same. But we have long-term debt, which is 74,000 in the fair market value, but on the book it's 66,000. So the long-term debt is book value 66 and fair market value is 74. Okay, so let's total this. So we're going to take this minus this. It's minus 4,000. We're going to do this for all. So you get 19,800 for inventory, plant. So these are the differences we paid. So in this 214,000 for inventory, which had a book value of 69 and the fair market value of 89. So out of this 214,400, we paid 19,000 for that one. So we're gonna subtract all this. We're gonna subtract all of that, and we are also gonna do 74,000 was the fair market value of the liabilities, and their book value is 66,000. So we had to pay more liabilities. So this is plus. We're gonna minus this. oops. So the difference between all of this and this, or why this is minus, is because their accounts receivable fair market value was 22,000 and book value is 26,000. So we actually paid more. So I have to take that out. So we're gonna do. Let me total actually all of that here first. So this is. So 169,000 of assets minus 8,000 of liabilities. This minus liabilities, and we get 161,800. Total is, just gonna move that here, 161,800. Now we can calculate their goodwill. This was the acquisition difference. We take that and we'll minus whatever we paid extra, and that would be our goodwill. So our goodwill is equal to total extra we paid minus that, minus that, the 52,600. This is our goodwill. Now we can also calculate non-controlling interest, NCI. NCI, because we know that this is the 410 is the full price and we don't have 20%. So that is 410,000. Get too many zeros there. And 0.20. So our non-controlling interest is that times that. It's 82,000. Now we're gonna make the balance sheet. So for the balance sheet, we're just gonna take the name, Company A. Company A, balance sheet. First thing we're going to take is cash. How much cash did we have? We had, Company A had 374,000. Company B had 10,400. So we're going to put A cash. Three seven 374,000. Company B had 10,400. 400. And how much we paid for this company? 328,000. So the cash, we minus it. It's 328,000. Have to minus it. So total is equal to that. Total is equal to that plus that plus that. It's 56,400. Next we have is accounts receivable. So their accounts receivable 84,000 plus 26,000 and minus this minus amount. So it's 84,000, 26,400 and minus 4,400. Next we have is inventory. Inventory is 100,000 plus 69,000 plus that difference between these two, or you can take 100,000 and actually the fair market value 89, but you have to show your work. So put this 100,000, 69,200, and the difference between these two was 19,800. That. So let's put inventory 100,000, 69,200, and 19,800. Next thing we have is plant. Plant is 514,000 plus 165,200, and also the difference between these two was 30,800. So we're gonna add all of them. So plant is 514,000, 165,200. See, 165,200, and the difference between these two is 30,800. 30,800. After that, we have patents. Same thing again, 104,000, 26,400, and the difference between these two. This one between two was 34,000. So we're gonna add okay, 104, 26, 400, 26,400, and the difference between these two is 35,600. 35,600. Okay, then we have trademark. We did not have any trademark for company A or company B. This is something new, so I'll just put 34,000. Okay, then we had that domain name. Domain name is also, we didn't have anything before, we just have this one, so it's 54,000. Okay, and then since it's balance sheet, we have to put the goodwill. Goodwill is 52,600. Goodwill. $52,600. Okay, now we're just gonna total everything. Okay, these are our totals. Okay, now we're just gonna total it. That is $1,368,000. I have to do liabilities. First, we're going to put current liabilities. Current liabilities are 36,000, and there is no difference, so it is only 36,000. Next, you just put this here, 36,000. Next we have is long-term debt. Long-term debt is 260,000 and 66,000. 260 and 60,000. And we also have to put the difference between this, that is 8,000. Okay, and then we have, let's just total this. That plus 60,000 plus 8,000, 300. I think we got something wrong. 66,000. And the current is 36,000. Next we have common shares. Common shares, we only take the common shares of company A. We don't take the common shares of company B. Common shares are 356,000. 356,000. Then we have the retained earning. We only take it for the company A, not the company B. Retained earning 396. Okay, that, and then we have to take out the non-controlling interest, where we don't control, which we calculated before. Our non-controlling interest is right here. It is 82,000. So non-controlling interest is 82,000. Now we're just going to sum it. And it did not balance because we forgot something. Current liabilities, we didn't put 164,000. That is right. So current liabilities we have to put for this company 164 plus 36. So 36, and our current liabilities were 164. And we do balance. $1,368,000, and this is how we do consolidated balance sheet. Okay, thank you very much.